Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today, Mena and I would like to talk about succession strategies. And this is obviously related to people that are self-employed that are thinking about what happens to their business when they're ready to retire or they're approaching retirement. And there could be many different things that you could do with your business, but we like to probably segregate it into kind of two categories. The first one we'll call transition, and this is the category we'll talk about this week. And the second is just a straight sale to a third party or unrelated party. The transition's really about handing over your business to people that already work in the business, or finding people to attract to your business and eventually handing over to them. But really it's handing over to someone that's kind of working in it. And it suits people that are going to, have a greater concern about, who's going to look after your business and who's going to look after your clients and be able to grow the business, and that you can potentially do that progressively as well. So let's begin, Mena. Let's talk about what a transition strategy might involve.
So the first thing to consider is your current structure of the business, because you need a unitized structure to allow for a transition strategy. So for example, if you're trading through a family trust or a discretionary trust, it doesn't give you a whole lot of flexibility when it comes to a transition strategy. Whereas if you're in a company or unit trust, you can progressively sell down your shares or units in that entity to the individual to allow for that transition strategy. So the benefit of a transition strategy is that it allows you to progressively sell down to key staff. So it gives you sort of a test before you actually are able to sell the full business. You still have control. You don't necessarily need to sell all 50% or 80, 90% of the business. You can start with 10, 20%. So it's a bit of a test before you buy sort of scenario. The benefits of this is that not only do you actually get to test before you buy, but it helps you keep key talent within your business, ensures that you maintain your business culture, because obviously you're using someone within your business already, so they know your culture, and it supports continuity of your business. So it ensures that, the ethos of your business is still being continued. Obviously, the risks are, if it's poorly executed, could be a mismatch of expectations. And we see this, frequently where, once a staff member could have ownership in the business and might sort of almost get to their head in a little bit, and they sort of feel, empowered to make wrong decisions or mismanage staff and so forth. Similarly, there could be, staff or client dissatisfaction or a loss of business value as a result of bringing that person along.
So, of course, how do you choose the right person that's going to be open to that role? And of course, it's your business. You can come up with your own sort of metrics about what you think is important for someone to sort of step into that role. But to my mind, an equity holder brings value that an employee can't, or brings additional value over and above what they're paid for. So, look, sometimes people, there's this book called The E-Myth, and there's 3 roles in a business according to this book. It's a very old book, written back in my time, but a good business book nonetheless. Anyway, the E-Myth says that there's technicians, managers, and entrepreneurs, and that's kind of the 3 roles in business. And a technician obviously is the person that's doing the work, the manager is the person that's managing the team, and then the entrepreneur is really just investing in a business, to kind of paraphrase. So you're not necessarily going to offer a technician equity in a business, because you can pay for that expertise. I mean, they come to work and they do their technician role. So my argument would be, what is that person bringing in addition to what they're paid for in that role? Similarly, if you can go and hire a manager that's going to look after a team, again, you wouldn't necessarily give them equity as well. So what are some of those things? Well, maybe the person has a really strong skill set in building systems. Businesses rely on good, repetitive, robust systems, and there's a lot of value in that. And as a business owner, that's one of your jobs, is to build systems that allow your business and the team in your business to deliver exceptional results. Attracting and retaining great team members, inspiring team members, creating a vision and a strategy, those sorts of things can also add a lot of value. Could be business development, if they're really contributing to the business's overall growth. Of course, that can be something that, might attract some sort of equity ownership. Look, I think the starting point is really understanding and recognizing what are those attributes. I was speaking to a client a few weeks ago that was contemplating a succession strategy, and I asked whether the person in his business was really doing anything over and above his salary, because we all get tired of, everything just resting on our shoulders as the person that owns the business. And we feel like sometimes, well, maybe if we sell equity to another person, it's no longer our sole responsibility. And that's true, and that could work. But I think in the long run, you'll be a bit disappointed if you're doing all the business development stuff, everything that's enhancing the value and driving the business forward, and then you've got to share some of that with someone that isn't actually bringing the same level of value.
So let's talk about how to structure the equity transfer. And again, this comes to what I was saying before in terms of making sure that you have a unitized structure. So in the first approach is to issue new shares or units if you're in a unit trust. So the benefit of this is it dilutes existing ownership, but and injects capital into the business. Now, the con of this is obviously that you don't get to necessarily take that capital back out because it's considered capital of the company. But the benefit is, or the flip side is, that you don't trigger CGT because it's not a sale, it's an issue of units or shares. The secondary option is the sale of existing shares. So this is what triggers CGT, but you get ownership of the funds being provided. So if you do go down this approach, then you need to consider, your CGT provisions and whether you're eligible for the small business capital gains tax concessions to help you sort of minimize that gain. So once you've sort of gone through that, I think the next thing to consider is transparency. You need to set clear KPIs for that equity holder. Although they're a business owner, I personally believe that no matter, even for yourself, you should really have KPIs. How they're sort of going to manage their financial commitments and, provide clear timelines up front. And before you do any sort of equity transfer, it's really important that you actually have a shareholder or unit holder agreement in place. So this will stipulate what happens, if there's a dispute, what the dispute resolution process is, if one partner wants to sell, what the general process is, and it can also outline key KPIs and so forth so that there's a clear guideline before you enter into the equity transfer.
Some other matters to consider are the business's valuation. So at what value are you going to sell the business to them for? And it's a bit of an interesting one because there's obviously some technicalities, what is a business's technical value, but then you've got to consider what's fair to both the purchaser and the seller, the vendor. So I think the answer is that everyone needs to be unhappy with the valuation. That's probably when you've reached the fairest point, by which I mean that if you as the business owner, naturally you want to maximize the value and you want to get paid for all the sweat equity, time and hassle and everything you put into the business. And that's fair enough, understood. But also you've got to really make sure that the valuation is attractive enough to the person that's coming into the business where they see value. They see that it's not only, a profit share arrangement, but I can see also how I'm going to spend the next 10 years contributing to and building this business and how I'm going to be rewarded for that from a valuation appreciation perspective. So if you set the value too high, then you sort of take that off the table. But conversely, as I said, you don't want to set it too low because, typically we only value what we pay for. So you certainly don't want to give it away for free, of course, but you don't want to set it too low. Now, the thing is, you can go off and get a valuation or you can speak to your holistic accountant. They might be able to give you some indicators of value, and you can have strong sort of technical arguments around what the multiple should be, whether there should be a discount for a minority interest, all these sort of technical matters. But at the end of the day, I think it's sort of part art, part science in that you've got to find a position that's fair. The next thing you want to think about is profit distribution. So, of course, you have a business, how much of the profit will you distribute each year versus reinvest in the business? And of course, the owners need to think about their own personal circumstances. So if you've got, a younger person coming into your business, they're probably going to have, a large home loan and desire to, build wealth and do all these sorts of things. They're probably keen for all the profit to be distributed. You just need to work out whether everyone's on the same page there and what's in line with the business. And as Mena touched on before, the best thing to do is have a prenup, which is really a shareholder or unit holders agreement, and really think about all the things that can go wrong in this sort of arrangement and come to terms with and work out what will you do in those events. So if someone is underperforming, if someone wants to sell their share of the business, if someone wants to exit completely, all those sorts of things, that's where you'd sort of cover off in a shareholder or unit holders agreement. And I think these sorts of relationships, the more effort and detail you put into them at the beginning, actually the less likely you'll have in the future as well.
So probably the last thing we want to touch on is around the time frame of a transition. Now, these things do take time. When you go through a relationship and, you're going to marry your partner, you sort of go through the whole dating phase. And it's a very similar sort of situation when it comes to ownership of your own business. It needs to take years. It needs to be deliberate. You both need to be on the same page. So it's really about ensuring you continue the culture in your business and you continue, what you originally were out to sort of achieve in your business. So in the next episode, what we'll discuss is what happens when you make a clean sale and what makes more sense, whether you sort of go down this whole transitions phase or if you're to make a clean sale, how that would actually play out and how to also maximize your sort of take home proceeds out of that sale. Until next time, bye for now.